A new study of the mortgage industry has added to the increasingly gloomy sentiment about the outlook for banks. According to JP Morgan and Fujitsu Consulting, growth in home lending will stay subdued for the foreseeable future, meaning banks will have to become creative to maintain their profit margins. Andrew Robertson reports.
Australian bank profits are heavily tied to mortgages. Mortgage growth has averaged more than 10% over the last couple of decades, but if last year's fall is any guide, those days are over.
We think growth will be lower for longer, so banks do need to look at the profitability of their existing book.
And to do that, according to JP Morgan and Fujitsu Consulting, banks must learn more about their customers and offer their products in a different way.
Up until now, essentially, most organisations have been developing products, pushing them into the marketplace and competing on price. With top-line growth coming away, now people have to realise that not all customers are equally valuable or equally interesting, and therefore you need to tailor and target your propositions much more carefully.
It's called customer segmentation, and JP Morgan's Scott Manning believes the big four banks are already well down that path as they try to capture an increasing share of a shrinking mortgage market.
We've seen Commonwealth Bank lead the charge with $1.1 billion investment in their core IT platform. That'll give them better identification of their customer base to be able to target specific offerings to specific customers so they don't over-service poor customers, but at the same time identifying profitable customers. We've seen National Australia Bank undergo their next generation platform as well as launch their online UBank product. And we've more recently seen Westpac launch their House of Brand strategies.
The big four banks did well out of the global financial crisis as competitors fell by the wayside, but those competitors are regaining their strength, such as mortgage brokers, who, according to Fujitsu, now have a pre-GFC share of the home loan market.
We're seeing a little bit of resurgence now of other lenders other than the big four, and they're quite heavy users of brokers. So I think brokers' volumes are reasonable, and certainly as a share of the total origination market, they're up to 41-42%, which is where they've been, not for 4 or 5 years.
Over the last 12 months, the share prices of the big four banks have all gone backwards, while the stock market as a whole has edged forward. Investor sentiment is not likely to be helped when the report of the Senate inquiry into the banking system is released next week. That's tipped to recommend help for second-tier players, as well as incentives for more foreign banks to enter the Australian mortgage market.
I really think it all gets down to having efficient funding, because you can get distribution through brokers, but you need to have a competitive funding proposition to at least get your pricing on par.
I think building societies and credit unions is a very important sort of secret source, potentially, of competition, but they're not actually really able to leverage it at the moment.
Any help for second-tier players will be good for consumers, but will only add to the challenges facing the big banks as they try to grow their profits in an environment that is slowly turning against them.